This is part one of our series titled Introduction to Investing, where we go over investment basics for college students. This is a summary of some of the information presented in the meeting. In the meeting, more information was shared as well as questions were asked and answered. So, to get the full experience and the full information, I recommend coming to the meetings. In this video, I'd like to introduce some of the most common and helpful investment options that could benefit our members. While there are countless ways to invest in our economy, we won't be able to cover them all in one session. That's why this talk will be a part of an ongoing series titled Introduction to Investing. Over the course of the series, we'll explore the basics, covering the most popular investment types, how to invest, and other key information to help you get started. It's important to note that the information I'm sharing is intended for educational purposes. I am not a licensed financial advisor, so this should not be considered professional investment advice. My goal is to provide an overview of potential investment options, and I encourage you to do your own research to see what might be the best fit for your personal situation. Before diving into any investment, it's essential to have a clear plan. Ask yourself why you are investing. Are you saving for a house, planning for retirement, or are you trying to build long-term wealth? Understanding your objectives will help guide your decisions. Remember, all investments carry some level of risk. It's possible to lose your entire investment in the market, so it's crucial to be fully aware of the potential risks involved. Some options are low risk while others are high risk, so thorough research is necessary before committing your money to any investment. Additionally, think about your investment timeline. How long do you plan to keep your money invested? For example, if you're planning to buy a home soon, you don't want your funds locked away in a retirement account with high penalties for early withdrawal. Understanding the timeline and the liquidity of your investments is key. Some investments might tie your funds up for 30 years or more. So before you get started, do your homework and plan wisely. I'd like to briefly touch on the topic of employer-sponsored investing. Many jobs offer retirement investment plans, which often come with an added bonus. Companies typically match your contributions up to a certain percentage or dollar amount. What makes this particularly beneficial is that the money invested is generally tax-free, meaning you can deduct your contributions from your paycheck and only pay taxes on the remaining income. Investing in your retirement account through your employer should always be a top priority. Not only are you avoiding extra taxes, but you're also receiving free money through your employer's match. By not taking advantage of this opportunity, you're essentially paying more taxes and missing out on additional funds that could help secure your financial future. Each employer offers different investment options, such as stocks, mutual funds, bonds, or more, and they are required to act in your best interests. Employers have a fiduciary responsibility to ensure the investments they offer are carefully chosen with their employees' benefit in mind. So, if you're employed and your company offers a retirement plan, it's crucial to take full advantage of it. Make sure to research your employer's matching policy and explore the investment options available to you. Since many of us either aren't employed or don't work for companies that offer these matches, I won't be spending any more time on the topic. But if this does apply to you, be sure to do your research, learn about the options available, and start investing as soon as you can. We'll be diving deeper into the different types of investments employers usually offer in these plans, like funds, bonds, and stocks, later in the presentation. So stay tuned for more details. With that being said, let's move on to some key investment terminology and then discuss risk management and diversification. Here is some helpful terminology that's important to know before continuing to invest. Something like securities is a term that's not commonly used and should be known. Something that I want to point out is at the bottom, a prospectus is a document that contains important information about a fund's fees, expenses, investment objectives, strategies, risk, performance, pricing, and much more. The prospectus is a very important document and should be read before making any investment. Pause the video now to read more about the terminology. When it comes to investing, risk management is key, and any qualified investor, including the Securities and Exchange Commission, which is the regulatory body overseeing the market, will strongly recommend diversifying your portfolio to help mitigate risk. Every investment carries some level of risk. There's always a chance of losing everything. We've all heard the saying, don't put all your eggs in one basket. The same principle applies to investing. If you place all your money into a single investment, such as one stock or bond, you risk that security underperforming or failing, which could lead to significant losses. This is where diversification comes in. Diversifying your portfolio spreads your risk across different types of investments, reducing the chance of a complete loss. Funds, like mutual funds or exchange-traded funds, have become popular options because they offer an easy way to diversify without having to choose each individual asset yourself. However, there are also individual stocks and bonds with strong performance and relatively low risk. The most important thing is to research what you are buying before making any investment decisions. Always remember to diversify your portfolio to help minimize risk and safeguard your financial future. Now, let's move on to discussing funds and how they can play a role in your investment strategy. Funds are an excellent way to diversify your investment portfolio with ease. Essentially, a fund is a pool of money that's collectively invested into a variety of assets and securities. There are many types of funds. Some track specific indexes or benchmarks, like the S&P 500, while others aim to outperform the market through active management. Because funds come in many different forms, they can vary greatly in terms of structure, goals, fees, and minimum investment amounts. With over 10,000 actively traded funds in the US alone, we can't possibly cover them all tonight. However, we'll go over some of the basics, such as the fees you might encounter, common fund structures, and the difference between mutual funds and exchange-traded funds. Let's begin by discussing the fees commonly associated with funds. You can have various fees, generally falling into two main categories: annual fund operating expense fees and shareholder fees. While active funds typically have higher operating expenses compared to exchange-traded funds, it's important to be aware of both visible and hidden costs. To start with some annual fund operating expense fees, we have the OER, or operating expense ratio. This is the most common annual expense, and it's a fee ranging from 0.25 to 1% of your investment, which is charged every year to your balance to keep the fund operating. Actively managed funds that aim to outperform the market with skilled investors usually have higher OERs than passively managed funds. There are also different types of fees, such as management fees, which cover some of the costs of hiring fund managers and other advisors. These are less common nowadays and are often baked into an OER. There are also things like 12b1 fees, which cover marketing, selling, shareholder services, and a variety of other expenses like custodial, legal, accounting, and administrative fees. There can be a variety of fees when investing in funds. Next, let's talk about shareholder fees. These fees are usually triggered when buying or selling funds, such as fees like a redemption fee, an exchange fee, an account fee, and a purchase fee. Before investing in any fund, make sure to understand all the possible fees that a brokerage may charge. All the fees and pertinent information must be included in a fund's prospectus, which we talked about earlier. Luckily, most brokerages now have much smaller fees due to the processes being automated. The most common fees most investors will encounter is an OER, a purchase fee, and then a sales load, which we will discuss now. Funds that charge sales loads are known as load funds, and those that don't are called no-load funds. Sales loads are commissions paid to brokers when you buy or sell fund shares, either upfront or upon sale. Load funds are split into two different classes. A front-end load, also called Class A shares, is a one-time fee paid by the investor when the shares are purchased. A back-end load, or Class B shares, is a one-time fee paid when the shares are sold. Level load funds, also known as Class C shares, are yearly charges and are a fixed percentage of the fund's assets. Class A and B load funds typically include most fees aside from the OER into the load fee. This means load funds can make fees and costs more streamlined and less noticeable as the fee is paid immediately when the security is bought and sold. While no load funds have no sales commissions, they might still have other fees such as redemption, exchange, account, and purchase fees. Additionally, brokers may charge transaction fees when buying or selling mutual funds, which can range from anywhere from $10 to $75. It's important to consider the long-term impact of fees. Even small differences can add up over time, making a big difference in returns. The next key distinction in funds is whether they are an open-ended or closed-ended fund. Open-ended funds are the most common types of funds, and this means that the fund can issue new shares continuously. Investors buy shares directly from the fund company, and the value of the share is adjusted daily based on the net asset value, or NAV. Most funds are open funds because it allows for constant investment into the fund. There is no dilution amongst investors because new shares are being created and old shares are being redeemed, keeping a balance. Again, the value is adjusted daily in accordance with the amount of shares for the fund. Next, we have closed-end funds. These funds issue a fixed number of shares. Unlike open-ended funds, their price is determined by investor demand, not the net asset value. As a result, shares may trade at a premium or a discount relative to the net asset value. Closed-ended funds are much less common and less applicable to our situation. Many closed-ended funds have high minimum investments and meant for those with millions to invest in. Next, I want to talk about passively versus actively managed funds. Funds can be either passively or actively managed. This is one of the most key distinctions between funds as the fees tend to be very different. There are a wide range of passively versus actively managed funds offered through many different brokerages and investment firms. Actively managed funds are funds which are managed by professionals who choose assets based on research and strategy. Actively managed funds try to outperform indices or a market to offer higher returns to investors. Each actively managed fund has a different goal or strategy for investing, which should be considered before buying. Again, read the prospectus. Although they offer their expertise, they also come with higher fees due to the active oversight involved. Investors tend to choose actively managed funds when they want faster, better returns and are willing to pay for such services. Actively managed funds are often mutual funds, which we will discuss more. Passively managed funds are funds which typically track an index or another benchmark like the S&P 500, top 10 tech companies, real estate development firms, and much more. Passively managed funds usually rely on algorithms and trading models rather than human managers. Because of this, fees are generally lower with passive funds. Investors tend to pick passively managed funds when they are investing for long periods of time and want to keep much of their investment as possible. Passively managed funds are often exchange-traded funds or ETFs, which we will discuss soon. Another key distinction between funds is mutual funds versus ETFs. Both can be actively or passively managed, but they differ in how they're traded and structured. Most mutual funds are actively managed, and they usually require higher minimum investments into the fund. If you want to buy a mutual fund, transactions are processed only at the end of the trading day. The price of the fund's NAV or net asset value is how the shares are determined. At the end of every trading day, the net asset value and the number of outstanding shares are calculated to determine a price for the end of the trading day. This ensures that all investors pay the same price for a given fund's shares on a given day. Like we talked about earlier, these funds can be open or close-ended too. Unlike mutual funds, exchange-traded funds are traded throughout the day like stocks, so prices fluctuate constantly. Most ETFs are passively managed and tied to an index like the S&P 500, which means lower fees for investors. Additionally, the minimum investment for an ETF is just one share, making them much more accessible for investors with less capital. ETFs can trade at a premium or discount relative to the NAV, so it is important to understand if the ETF is trading in such a way. Very large and very popular ETFs often trade very closely to their NAV with very small premiums and discounts because big firms are able to quickly capitalize on the small price differences. If you're investing in smaller, less tracked ETFs, that is where they might trade at premiums or discounts of 1% and higher. Investors should make sure to do their research before investing in any type of fund. As you can see, funds come with various structures, fees, and management styles. Understanding these basics will help you make more informed decisions. Always do your research before investing and make sure to consult with a licensed investment advisor or tax attorney to understand what's best for your individual situation. For many of us, low-cost ETFs that track indexes are a perfect start. Make sure to know the risk before investing as well. Every investment comes with a risk. Now, let's move on to discussing bonds and stocks as they are the next key investment options. Begin with bonds and certificates of deposit, or CDs. When you invest in a bond, you are essentially lending money to a company or organization with the promise of repayment plus interest. CDs, on the other hand, are deposits made with a bank that you agree not to touch for a set number of years so the bank can loan that money out. Both bonds and CDs are typically long-term investments with terms stretching 10, 20, or even 30 years. Bonds offer a low rate of returns, but are generally very low risk. They can be an excellent long-term investment with a guaranteed rate better than if deposited into a regular savings account. Consider investing in bonds to lower the overall risk of your investment portfolio. There is still a risk, of course. If the issuer of the bond can't pay back what they owe in the future, you could lose money. To help assess this risk, bonds are getting ratings by major agencies like Moody's, Standard & Poor's, and Fitch. These ratings range from AAA, the highest, to lower grades that indicate increasing levels of risk. Only a few entities, such as Microsoft and Johnson & Johnson, currently hold the coveted AAA rating. While you can still sell bonds before their maturity date or withdraw money from a certificate of deposit early, both options come with their challenges. Selling bonds can be difficult and might incur fees. Cashing out a CD ahead of time will almost always result in a hefty penalty, which can really hurt. While bonds usually offer lower returns compared to other investments, they are often seen as one of the safest ways to grow your wealth. However, they can sometimes require higher initial deposits, making them a bit harder to get started than with stocks or funds. Fortunately, many of the major brokerages offer bonds with more accessible minimum deposit requirements. It's also worth noting that bonds issued by governments or municipalities like Orange County can often be tax-free, which makes them an especially efficient investment choice. Many people invest in bonds or CDs as a part of a strategy to maintain steady cash flow or reduce overall risk in their portfolio. While bonds from the US government are generally considered among the safest investments, it's always important to remember that every investment carries some degree of risk. Ultimately, bonds and CDs offer a variety of payout schedules and risk levels. It's essential to do thorough research and consult with financial experts before making any decisions. Now let's turn to stocks, one of the most fundamental forms of investing. When you purchase a stock, you're essentially buying a small piece of ownership in a company. With that ownership comes certain rights or privileges depending on the stock. So it's important to know what you're getting into. Some companies distribute dividends of their profits to their shareholders, while others do not. At its core, investing in individual stocks is about choosing companies that you personally believe will succeed and grow over time. These are generally long-term investments, meaning you're buying with the intention for holding for years, not weeks or months. However, buying individual stocks does come with its own risks. If the company doesn't do well, you could lose a significant amount of money. Lots of investors compare investing into single stocks to gambling. It can be a lot like placing a bet on a company's success at the poker table. Still, many investors choose to invest in stocks that they believe in, and some stocks do show steady, consistent growth over time. That being said, investing in individual stocks should be approached with caution and should generally make up a smaller portion of your overall investment portfolio. Don't overinvest in individual stocks when you can easily invest in funds that often have higher returns. Won't be diving into any more advanced stock trading options or techniques or strategies tonight, as the goal is to cover the basics. There are a variety of platforms where you can get started, such as Robinhood, E-Trade, Ally Invest, Charles Schwab, Fidelity, JP Morgan, BlackRock, Vanguard, and more. Many of these platforms offer low fees and small minimum deposits, making them accessible to new investors. But remember, before investing in individual stocks, they can be risky. So be sure to do your research and choose the platform that's right for you. Tonight, I've introduced you to three of the most common and foundational investment options: bonds, CDs, and stocks. My hope is that now you feel a bit more confident in understanding these investment vehicles and are excited about the possibilities ahead. Again, this information is only a part of what we shared in the actual meetings. Questions were answered, and we just shared more information in general. So please, I recommend attending the meetings. And again, this is just a starting point. Always do your own research and consult with a qualified financial investor or tax professional to determine what's the best for your individual situation. So thank you for your energy.